All right, let's talk about risk. Today, we're going to build a kind of blueprint for understanding one of the biggest ideas in finance, the risk you take on when you invest in stocks. Let's get right into it.
You ever feel like this? You put your money in, the market goes up, it goes down, and it can all feel like a total shot in the dark? Well, if you have, you are definitely not alone. But here's the thing, it's not just guesswork. There's actually a logic to all that uncertainty, and by the end of this, you're going to have a map to navigate it.
Everything really starts right here. See, when you buy a stock, you're not just buying some symbol on a screen. You are buying a small piece of a real business. You're an owner, and that means you have a claim on the company's future profits. Now, that's where the opportunity is, but it's also exactly where the risk begins.
Okay, think about it like this. A bondholder, well, they're basically a lender to the company. They get paid first, and they get paid a fixed, predictable amount of interest. But stockholders, the owners, we get whatever is left over. We are the residual claimants, and that single difference is the entire game. It's why stocks have so much more potential for big returns, but it's also what makes them so much riskier from the get-go.
So, we've established that stocks are risky, but, risk is a pretty vague word. To really manage it, we have to diagnose it first. Because risk isn't just one thing. It actually comes in a few very distinct flavors.
So first up, you've got business risk. This is all about the company itself. Are people still buying its products? Did a new competitor just show up? Is a recession hurting its sales? This is the core risk that the business just might not do as well as everyone hoped. And then there's financial risk. This is all about how the company manages its money, specifically its debt. If a company borrows a ton of cash, that's what we call leverage. It's like pouring gasoline on a fire. When things are good, they can be great. But when things go bad, they can get really, really bad because those debt payments have to be made no matter what.
And finally, we have the big one, market risk. Sometimes, the entire stock market just goes up or down for reasons that have absolutely nothing to do with one specific company. It's that tide that lifts or sinks all boats, no matter how well run your particular company might be. And this right here, this brings us to probably the most important distinction any investor can make. All those risks we just talked about, they fall into two main buckets. You have unsystematic risk. That's all the company-specific stuff. And the good news about that is you can get rid of a lot of it by just not putting all your eggs in one basket. That's called diversification. But then there's systematic risk. That's the market risk. And that is the one risk you can't diversify away.
Okay, so if we can't completely get rid of all risk, how do we at least measure what's left over? How can we possibly put a number on our exposure to that one risk we just can't escape? Well, lucky for us, investors have a toolkit for this exact problem.
Now, there are a few key ways to measure this stuff. You've got standard deviation, which is really just a measure of the total ups and downs. There's value at risk, which tries to estimate how much you could lose. But for our blueprint today, we're going to zero in on that second one, beta, because it measures the one risk that truly matters if you have a properly diversified portfolio.
Beta. That's it. Just one single Greek letter. But packed inside this little symbol is one of the most powerful concepts in all of modern finance.
So what is this number actually telling us? Why is it such a big deal? Well, it answers the most critical question for any diversified investor, which is, how much market risk am I really, truly taking on with this investment? Here's what it is. Beta measures how sensitive a stock is to the movements of the overall market. It puts a number on that systematic risk we talked about, the risk you can't get rid of, and so it's the risk you expect to get paid for taking. A beta of 1 means the stock basically moves in lockstep with the market. A beta times over 1 means it's more volatile. It's like a stock's personality. Is it a steady cruise ship, or is it a white-knuckle roller coaster? Okay, this is where it gets really cool. We've diagnosed the different kinds of risk, and we found a tool, beta, to measure the one that really counts. So how do we put all that together to build a smarter portfolio? Well, that's where we finally unveil the blueprint, capital market theory. Now, the goal of this whole theory is actually pretty simple, but it's incredibly powerful. It's not about chasing the absolute highest returns possible, no matter what. No, it's about getting the best possible return for whatever amount of risk you personally are comfortable taking. It's all about being efficient.
All right, hang with me here, because this is where the magic happens. Imagine you could plot out every single possible combination of stocks. The efficient frontier is this curve that represents all the best possible portfolios, the ones that give you the most bang for your buck risk-wise.
Now let's add something with zero risk, like a government bond. The theory shows us that the smartest path for any investor is a straight line from that risk-free investment to the single best point on that curve. And that line, that is the capital market line. It's your roadmap.
So what about that single perfect spot where the line touches the curve? Well, that is called the market portfolio. It's the most diversified portfolio you could possibly own. Now, in theory, it's supposed to include every single investable asset in the entire world. But in the real world, you can get pretty darn close by just investing in a broad index fund, like one that tracks the S&P 500 or the whole world stock market.
Okay, I know this all sounds a little theoretical, but the takeaway from it is incredibly practical. What this blueprint gives every single investor is a clear, logical way to build their portfolio based entirely on their own goals.
The game plan is actually pretty straightforward. You start with the most efficient option, the market portfolio. From there, you just decide your own risk level. If you're more conservative, you simply add risk-free things like bonds to the mix. If you want to take on more risk for potentially higher returns, you can use leverage to own even more of that market portfolio. You're just choosing your spot on that line.
And this quote just sums the whole thing up perfectly. Instead of playing the really hard game of trying to pick individual winning stocks to beat the market, the theory says it's much more rational to just own the entire market and then decide how much of that market risk you're willing to take on.
So there you have it, the investor's blueprint. It's not about trying to magically get rid of risk. It's about understanding it, measuring it, and then making a clear, intentional choice. It gives you a framework to go from feeling like you're flying blind to navigating with a real map. So the only question left is, where do you want to be?